Hello everyone and very good afternoon to all. Today we are going to have webinar on IT sector. We have Mr. Apurva Prasad who is an institutional research analyst. He is having experience in tracking IT sector for more than 15 years. So I hand over the topic to explain in detail to Mr. Apurva. You may take the presentation ahead.
Thank you. Thank you, Kushbu, for the introduction. And good afternoon to all the participants. It's a pleasure and a privilege to speak to you. We thought it's quite apt to look at the sector. This is among the leading sector in terms of market capitalization. And it's if you look at the trajectory over the last few years, uh, 2020 was a very strong year for the sector, followed by 2021 that was even stronger, and then we had a big correction in the year 2022. 2023 is when the sector, the larger companies are pretty much flatlined, uh, and so what we're really trying to understand what lies ahead for the sector, which is what we thought is the good theme for this webinar. Let me just quickly give you a snapshot from our very recent note, so that we understand where do we stand in terms of stocks and what we're looking at before we get on to what comes up ahead. So let's look at what's happened already. So if you see, and Kushbu, you have to tell me if this is visible, Exhibit 47, which is visible.
Yes, it is visible.
Perfect. Perfect. Okay. So yeah, this is. I know it's a very cluttered exhibit, but yeah, I'll just draw your attention to the 3-year and the 5-year percentage columns. That's the third and fourth last column. That's really what has been the stock return over the last 3 years and 5 years cumulative. And as you can see, the sector has, despite the correction that has happened last year, it has still outperformed. And if you see over the last 10 years also, the sector has outperformed the benchmark, which is the Nifty, as well as an index like Nasdaq. You can see big divergence between some of the bigger companies and some of the mid-sized companies in terms of stock performance. So if you have to look at companies like a Tata Elxsi or a Persistent System, these are companies that are up 8 to 9 times over the last 3 years, given significant returns. Even if you look at companies such as a Mastech or company like a Cyient, they've given very, very high returns over the last 3 years and 5 years. And what you're looking at is the relative underperformance more recently by some of the larger companies, which is also true for a longer period of time, 5-year, 10-year time horizon. So what we have done really is, in this particular note, we've looked at the end clients of the IT sector, and with the assumption that the health of the end clients will determine the health and the performance of the IT sector. That is certainly one way to assess the near-term performance of the sector. So going by that, there are a few observations that come to us. First is, if you look at the largest vertical, which is BFSI, and let me just sort of before I just get to that point, I want to say, why is this important? So why should we be looking at end clients to assess the health of the sector? And the reason we should be doing it is this Exhibit 8, which is nothing but the performance of the S&P 500 companies, uh, which is compared to the larger Indian IT companies. That's the correlation. So as you can see, it is very highly correlated, because a lot of the S&P 500 companies are end customers of the IT companies. So the correlation is very high, that what we have seen. And therefore, to assess the near-term performance of the IT companies, it makes sense to look at the end customers. And this correlation plays well across all verticals. So Exhibit 11 and 12 is how it is played out historically for the overall sector. Exhibit 13 and 14 is how it is played out for the BFSI vertical. Again, you see a very high correlation between BFSI. So think of the largest banks, which are customers for Indian IT, large insurers, whether it is on the PNC side, they're all large customers, whether it is retail and CPG segment. Again, you see very high correlation there. So what we have essentially done in this note, and I must encourage you to spend some time here, is we have listed out all these large customers of IT companies, mapped it to which are the IT vendors, and looked at the performance of some of these enterprises and arrived at a particular score by doing this exercise. So just as this is done for the BFSI vertical, we have done a similar exercise for retail and CPG, and you can see all the large customers there, which are mapped to the Indian IT companies. Uh, that's what we have done. And similarly for manufacturing vertical, where you see large enterprises, again, which has done relatively better. You see more greens there compared to some of the other verticals. That is essentially what we've done. So what it all boils down. I don't want to take you through so much of numbers, but Exhibit 1 is where I would want to draw your attention to, which is the final score. And a higher shade implies a higher score or a better score. So as you can see here, that purely on this exercise, we believe that TCS is looking relatively better as compared to Infosys. HCL Tech is looking relatively better as compared to a Tech Mahindra. At the same time, most of the mid-tier IT companies at an aggregate level are looking better than tier one. So what we're trying to say is that the outperformance of mid-cap IT and small-cap IT that should continue going forward also. Exhibit 4 is really so this chart is nothing but the scale versus growth guidance given by all the large global companies as well as mid-sized companies. So as you can see, it is quite inversely correlated. So a larger company typically growing lower. So I think part of this is also to do with the scale. Part of it is to do with the fact that a mid-tier IT company is able to compete a lot better as compared to the way they were competing with tier one IT companies. So the competitive landscape is very different versus where it was earlier. And what it means is that it allows many of the mid-tier IT companies to grow faster. And when I'm saying faster, so think of if FY23, the large companies did 12-13% growth and mid-tier companies did 20% growth. FY24, the larger companies will slow down to 5 to 6%, and this is all in constant currency. And the mid-cap at the same time, they will still grow at a good premium. So they can still do 14-15% plus type of a growth rate for FY24. And this is in a year that macros have become more challenging. You're looking in a scenario where uh, there are cuts in discretionary spending, is what we're seeing. There is delay in decision making, which means lower conversion from the pipeline to the TCV. It also means there is slower deal ramp up, which is slower conversion from TCV to ACV. At the same time, there are different dynamics for pricing and volumes which are taking place in the market right now. So where we are is we believe that the medium term prospects for the sector is still strong, which is that beyond FY24, growth rate will rebound back to high single digit for the sectors, and we do expect mid tier IT companies to grow at mid to high teens level uh, beyond that. But at the same time, in the near term, it's the growth divergence between most of these companies are going to increase. And to just illustrate that point to you is all that I just mentioned. If I have to graphically tell you what I mean is really this. Exhibit 46, the x-axis is the earnings growth and the y-axis is the valuation. So yeah, I mean, you have to look at the bottom right quadrant, which is the best quadrant, which is the highest earnings growth at lower end of the valuations. These are the stocks which could outperform. That is the one that you're looking at. So from The mid-cap space, the one that we like most is Persistent Systems, which is the one that features right there, 24-25% earnings compounding over the next 2 years. And from the small cap universe, we like Zensar, which we have recently upgraded further. So a Zensar with the margin expansion is looking at very strong earnings CAGR. So that is the other stock which we like. And as you can see in this exhibit also, this is located in the right bottom quadrant, which is the place where ideally one should be. And within the larger companies, if one is to look at LTI, Mindtree would be the one which would be preferred within the larger one. If I have to include LTI, Mindtree within the top 6 IT companies, looking at a large cap company. So the way we look at it, it's going to be a challenging macro environment, which means that Q1 and Q2 the growth prospects would be slightly muted as compared to what they have done historically. So Q1 will certainly be quite weak, and then we expect recovery after Q2. So second half of FY24, we expect growth normalization. This is what we have built into our numbers. What's happened at the same time is there has been a very steep correction in the valuations. So valuations have come off by almost 30% from peak levels. So a lot of these risks are also captured because valuations today are very close to long-term averages as compared to being much higher, 30-40% higher than long-term averages, which is what we saw early part of last year. So all put together, we expect the large cap companies to give returns, very modest set of returns of mid to high single digit type of a return. But we expect some of the mid cap companies and small cap companies to give very strong 15-20% plus type of a return from the next 1 year point of view. Khushbu, I'll just take a pause here, and would request the participants, if you have any questions, you can post that, and we can probably take some questions.
Yes. Customers, you can write in the questions tab if you have any questions. We have one question. Can we discuss outlook for Tata Elxsi and LTTS? LTTS?
Sure. So Tata, so both are those companies which is under our coverage. We cover both these companies. They are essentially ER&D services companies. These are companies which have been growing faster than peers because of some of the industry-related drivers which are helping them. Where they address the customers is the R&D side of the business. So whether it is a large automotive company, or it is a large industrial company, or it is in the field of plant engineering, or if it's a large semiconductor company. The end customers vary across different industries. The fact that the penetration is very low of ER&D services, the outsourcing piece is much lower. So if you see IT services, 30 to 40% of the overall 1.3 trillion dollars is outsourced. But for ER&D companies, the outsourcing is less than 10%. So one of the things that is happening is that the outsourcing component in the ER&D companies, the ER&D segment is increasing. So Tata Elxsi and LTTS, now these are both companies where, so in case of Tata Elxsi, they have very strong niche in the transportation vertical, where they have been working with some very large OEMs and some very large tier 1 or auto ancillary companies. They have a very large broadcast and media practice where they work with carriers, where they work with semiconductor companies, uh, they work with OTT providers, they build platform for them. So there is a large media broadcasting segment, and then there is a large design arm which they have, which is about 10-12% of the revenue. So the company in the last few years has very clearly outperformed most of the peer set. We expect them to continue to grow at 15 to 20% bracket. We're building in right now more like 15%, but I think the if things improve in a couple of segments for the company, that growth rate could improve further. Uh, uh, the area where Tata Elxsi scores very well compared to peers is on the margins. So they operate at almost 10 percentage margins higher than their competition, and that is because of their delivery model. At the same time, the services that they offer gives them better pricing. So, which is why you see very high margins for Tata Elxsi. So, I think we are currently building in that they can hold on to the current margin levels, and all of this gives them 15-16% type of an earnings CAGR. The problem that we have out here is on the valuation side, where company is trading at 50 times valuation. So, while the company has got attributes that it will be expensive, it will remain, the valuation will be on the higher side, but 50 times is a bit of a stretch. So which is why we have our sell rating. Our sell rating is a reflection of the high valuations that is there for the company. So we believe that the fair value is much lower, and therefore in a scenario that the stock corrects, one could look at more attractive levels. But from the current price points, we do have a sell rating on Tata Elxsi. In case of the other one, L&T Technology Services, this is a more diversified ER&D company as compared to Tata Elxsi. Valuations are much lower, but at the same time, it continues to be on the higher side for the company. Growth rate of this company is much lower as compared to Tata Elxsi. So they should be growing closer to low teens level on an organic basis. More recently, the company has made a large acquisition, and this will be the first quarter when the entities will be integrated. Uh, we do expect the company to hit 1.5 billion revenue run rate in FY25. So that outlook holds. But at the same time, because there are not enough levers for the margins of the company to go up because of the business mix of the company and because of some of the acquisitions. So what will happen is the growth which will come in a top line on an earnings level, it will be much lower for the company. And for that, when we look at valuations, it looks fully priced, and therefore we have a reduced stance on an L&T Technology Services. So we do believe that uh, uh, better levels. I mean, the stock needs to correct more for entry at better levels, but from the current levels, it is a reduced rating that we have. Push go over to you.
Okay. Could you show the outlook for Cyient, Wipro, as well as Birlasoft?
Sure. So, so while Birlasoft is not under our coverage, we don't have a rating on that company. But the company, what we can say is that the company has strong pedigree on the SAP and Oracle side of the business. So some of the legacy ERP side of the business has been their core strength in that company. Uh, if I move to Cyient, again, just to continue on from where we left on the ER&D discussion on Tata Elxsi and L&T Technology Services. So Cyient is another very strong ER&D company. In fact, if there is one ER&D company which we recommend currently buying, it would be Cyient. The stock has outperformed more recently. There have been some leadership transition which is taking place in the company. The company has historically been very heavy on the aerospace side of the business, which used to drag on the overall performance. Now that is turned around very impressively and is expected to continue, which will be supported by the resurgence or the strong outlook in the travel and hospitality, which is what is helping Cyient. And Cyient, because also the valuations are much lower as compared to peers such as Tata Elxsi or a company like L&T Technologies. So 15 to 20% kind of a growth rate is what the company can do, and because of where valuations are, I think one can expect those kind of returns going forward. Uh, Moving to Wipro, while we do have an ad, we don't see much of an upside from the current levels. Like I said, within the larger IT companies, we prefer an LTI Mindtree there, which is the only buy rating that we have within the top 6 IT companies. But for Wipro, uh, the near-term performance will probably be weaker than all their peers. So in Q1 quarter, the company will be declining sequentially. That is what they have guided. At the same time, they're going to be falling back in terms of their performance as compared to peers. So the room for improvement is large. Uh, Following the change in leadership which happened about 3 years back, there was a period where the deal activity had picked up for the company. The company became uh, much more aggressive in making acquisitions. So they've taken a very strong bet uh, in the consulting side of the business on the BFSI side. So the current macro scenario is affecting their portfolio more than some of the other companies. But in a scenario that macro environment improves in a few quarters, the portfolio of Wipro can start to look can start to actually look better. The other drag for the company is on the margin side, but I think there is room that it could improve. That 16.5% EBIT margins can catch up to some of the larger peers, and it could get much higher. So which is why it could improve. So the problem is more on the top line growth, which is more near term, and things could improve. But because of some of the near term problems, it's going to affect numbers, and therefore we think from a 1 year point time horizon, there is not too much of an upside. But beyond that, one could look at better returns.
Okay. Could we also share the outlook for Mastec? And should we invest now in mid-cap IT or there are any chances for correction?
Sure. So, look, IT has, which is what I said initial part of our discussion, that there is a wide divergence between the performance. And let me just try and take you back to, let me just screen share and tell you what I'm talking about. So, if you see the difference in terms of performance, and let's look at uh, the last 3 months. Khushbu, I hope the screen is can be
Yes, it
seen.
is visible.
Yeah. So if you see what I was referring to is the divergence in the stock performance is reflected if you see the third column, which is the 3 month performance. So if you see the top 5, 6 companies which are either flat, and Infosys has corrected the most. This is after the Q4 results. But if you see most of the others, they've pretty much flat. These are all in percentage terms. Whereas if you go down, if you start going down below Tech M, you will start looking at much stronger set of returns by some of the companies. So companies like Cyient, Sonata, Zensar, Mastec, including these are the ones which have done well. So yeah, it's uh, been a bit different for both the sets and size of companies. So it's certainly a good time to be buying companies like Persistent Systems within the mid caps. Certainly a good time to be buying companies like a Zensar, buying companies like a Sonata. Uh, Mastec also, there was the question on Mastec. Yes, we do have an ad rating, although the upside is not as strong as some of the other names that we discussed. But yes, I mean, we are also positive on Mastech overall. So the business again is a little unique, different compared to some of the other peers. They are more heavy on the UK geography as compared to most of the peers which are heavier on the North American side. And even within UK, a big part of it is work that they do for the UK government. Uh, and with some recovery that we are seeing in that particular geography, and the fact that companies scaling up the US geography courtesy more recent acquisitions. The growth prospects is certainly strong for the company. So yes, we are positive on Nasdaq stocks, which one should look to buy. Like I mentioned, LTI, Mindtree will certainly be there from the larger ones. Persistent Systems within mid cap, Zensar within the small cap.
Okay. Could you suggest which mid-cap IT company is likely to outperform? And can you provide sector-wise names of the companies who are customers of IT companies?
Yes. So yeah, I'm just reiterating my point. But yeah, the outperformance, and I will take you back to uh, the slide which makes it very evident. So this is again back to exhibit 46. The outperformance is the quadrant that you are looking at is the right bottom block. That is the one which is better. So it is higher on earnings growth and lower on P, which is the best filter. So you can see the names there: Persistent Systems, Sonata, Signed, Mastech, Zensar. These are the ones who are a combination of lower P and higher earnings growth. The outperformance can be expected. They have been, many of these have been outperforming. Uh, at the same time, we believe this can continue. So from a sustainability 2 year, 3 year time horizon, which company can do well? Persistent Systems, which is a large mid-cap company now, they can continue to outperform. So yeah, that's that.
Okay. Uh, how would you suggest the Tanla solution? What is the future of the stock for 5 years?
Yeah, so Tanla, I would not be able to speak. We do have that company in coverage. It's my colleague Amit Chandra who covers this. We do hold a positive recommendation on the company, but that's not the company I cover, and therefore this would not be the best forum to speak. You sure?
Yes. Yes, you may continue. Should I repeat the question?
No, I just answered the Tanla question. The next one, if you have any.
Sure, sure. What is the future of IT companies dealing with AI and defense sector?
Sure. So it is certainly talked about as the next big disruption. So futurists and technologists have compared this to what internet did. Think of what it did to productivity when internet came, um, and when smartphones came. So what does that do to productivity? The only difference here is the adoption rates are much faster. So that x-axis is shrunk a lot more than what happened in some of the previous disruptions. Uh, so yes, I think there are two ways to look at it. One, while at the same time it could, there are a lot of productivity levers for the software developers, which means you may require fewer programmers to be writing codes for the end customers, fewer people to be carrying out testing. But at the same time, what it's going to do is it's going to create newer use cases. We're already using a lot of AI around, with most of the apps that you use. Uh, but what's really happening is that the whole market around AI is getting a lot bigger, and which is why there are different estimates of how large that can be. So yes, like what happened with cloud a decade back, and with AI, which is taking which is going up much more meaningfully more recently, supported by what's happening around generative AI. So I think the prospects are very strong. Most of the IT companies, and this is from an IT company standpoint, have been building POCs and use cases across different industries. So while the applications are more on contact centers, chatbot related, which is sort of more in use right now, but it is going to penetrate a lot more. So there are different estimates in terms of how much productivity enhancement can come about with artificial intelligence. But yeah, that's certainly going to be a big driver of tech investments that enterprises are going to be making. So it's what's happened is because of what ChatGPT has done and generative AI, it's become part of all boardroom discussions by all the large companies, and nobody wants to miss this, because you had, when the cloud wave came much earlier, and you had some of the large hyperscaler companies which benefited from that. Most of the early adopters benefited. So, which is why when we say that the medium-term prospects of the sector look strong, it is because of this whole ability of multiple waves in technology that the sector has seen, and the fact that you can train and retrain and upskill the workforce across technology cycles, which is what we have seen in the past. So whether it was the ERP wave, whether it was the IMS wave, or more recently the wave on cloud, both hybrid public, we have seen this in the past. So it's going to be similar to that, but possibly a lot faster with some of the disruptions taking place.
Okay. Could you please suggest top three companies where investment could be parked for short duration, like 2 to 3 years?
Sure. So I would again reiterate some of our top picks that we have. So let me recommend from the large cap companies and LTI Mindtree. It's two mid-sized companies coming together, and which even prior to that merger, they were competing with many of the tier one IT companies. There is a lot of synergy between both the companies, and it's more recent. The company is going to get a lot of operational benefits, some synergies, and which is why the margin of that company is also going to improve over the next 2 to 3 years. At the same time, we expect that they will be growing much faster than their large peers. Very strong set of competencies in many of the newer technologies. So LTI Mindtree, for that reason, is what we would recommend for 1 year and beyond that period time frame. From the mid cap side, we recommend a Persistent Systems. Very strong pedigree of the company, more on the software product development side, but at the same time, very strong practices across 2, 3 large verticals, 2, 3 specific verticals in which they operate. So we do expect that company also to outperform and give better returns.
Okay. Uh, Nifty IT sector average historical PE is 18 to 20. Now it is still 25.5 PE. So it's still overvalued, correct?
Yeah, so it's not exactly overvalued, but let me just break it down for you, with what that range is and how that's been in the past. So if you see historically, and this is a 1 year forward, number that I'm referring to. So what the earnings were, 1 year ahead, and how much was that getting priced in. So based on that, you're right. The multiple is about 19 and a half times or so, to be sort of more precise around that. Where it is right now is not 25, it's probably more like 22 times 1 year forward earnings is where they are. But let's not forget, this was almost above 30 times. So let me just quickly screen share. I have that exhibit. I can just share that. Yeah, I hope this little chart is visible. Nifty IT index valuation. Khushbu, please help me.
Yes, it is visible.
Yes, so that's the 10-year trend of P multiples, as you can see, and which had gone to in December 21, gone above 30 times, and it's corrected since then. It is, you're right, it's still above the averages, but it is well below uh, the high point. It's certainly off the high point. Push over to you.
Yes, can we expect correction in Oracle in near future?
That's Oracle Financial Services is stock which is not in our coverage, so we don't have a recommendation in that. What we can certainly say is that one of the interesting things in the company is uh, the dividend yield, which has been there. They've been fairly consistent in that payout. So I think maybe the valuations and the performance would be correlated to that. But since we don't have a recommendation, I cannot comment on this. Push over to you.
Okay, yes, I think we have answered most of the questions. We can give a closure remark and end the session.
Perfect. Thank you. Thank you very much, ladies and gentlemen, for attending this. It's been a pleasure and privilege, like I said earlier, to speak to you. And you may please reach out to us. And thank you so much for your time and attention.
Thank you, Apurva. Thank you